Good morning, everyone, and thank you for joining us to discuss MEG Energy's year-end 2024 financial and operating results. With me on this call this morning are Ryan Kubik, our Chief Financial Officer, Lyle Udepsky, our SVP of Legal and Corporate Development, and Eric Olson, our SVP of Marketing. I'd like to remind our listeners that this call contains forward-looking information. Please refer to the advisories in our disclosure documents filed on SEDAR+ and on our website for more of these disclaimers. For full details on our year-end results, please refer to yesterday's press release. 2024 was a significant year for MEG. We proudly celebrated our 25th anniversary and our continued maturation as a leading pure-play thermal oil producer. We are focused on delivering increasing free cash flow per share and sustainable shareholder returns. Thanks to our team's unwavering focus on safety, operational excellence, and disciplined capital allocation, we were able to improve our safety performance, achieve record production, hit our net debt target, institute a quarterly dividend, and sanction our facility expansion project. I now want to touch on some key points that speak to our strong financial and operational performance. In 2024, we generated approximately $1.4 billion in adjusted funds flow and $837 million of free cash flow. This strong cash generation enabled us to fulfill several key commitments to our shareholders, including balance sheet strength. We reached our $600 million net debt target following through on a focused multi-year deleveraging strategy that began in 2018. Return of capital. We instituted a sustainable quarterly base dividend of 10 cents per share and repurchased and canceled 17 million shares. Over the last 3 years, we have returned over $1.3 billion to shareholders through share repurchases and dividends. Production growth. We achieved our fourth straight year of record production at just over 102,000 barrels per day, delivered at a steam-to-oil ratio of 2.39, reflecting strong operational efficiency from our Christina Lake asset. Improved bitumen realizations. We benefited from our strategy of maximizing access to tidewater to reach new international customers and improve realized bitumen prices. Heavy oil fundamentals significantly improved through 2024 as the TMX pipeline provided unconstrained egress from the basin. WTI to AWB differentials narrowed to approximately $16 per barrel in 2024, a $5 improvement over 2023. In the fourth quarter specifically, the WTI to WCS discount tightened to $12.56 per barrel from $21.89 in the fourth quarter of 2023. This represented a 43% improvement. These tighter heavy oil differentials and reduced volatility demonstrate the importance of delivering Canada's energy to global markets and its fundamental benefit to Canadian heavy oil pricing. It also highlights why continued discussions surrounding diverse market access for Canadian oil and gas remains important. Now, I'd like to turn the call over to Ryan for a discussion of our financial performance.
Thanks, Darlene. MEG generated about $1.4 billion of adjusted funds flow for the year. Continued focus on cost management again yielded excellent results. 2024 operating expenses net of power revenue were top quartile at $6.32 per barrel, including non-energy operating costs of $5.39 per barrel. Capital investment for the year was $548 million, which included the start of our multi-year production growth strategy. After capital expenditures, MEG generated $837 million of free cash flow, enabling us to repay our remaining 2027 notes and repurchase 17 million MEG shares, or about 6% of our 2023 year-end outstanding shares. In total, including $27 million of dividends, we returned $481 million to shareholders in 2024, up from $446 million in 2023. Our share repurchase strategy has also enhanced our per-share metrics, delivering a 5% increase in adjusted funds flow per share. In 2025, we expect to deliver strong results. Production guidance is between 95 to 105,000 barrels per day, including the approximate 8,000 barrel per day impact of our second quarter turnaround. Non-energy operating costs are expected to remain highly competitive at between $5.30 to $5.80 per barrel, and capital expenditures are estimated at $635 million, including $130 million associated with our facility expansion project and $70 million for the turnaround. With low leverage and no debt maturities until 2029, we continue our commitment to shareholder returns, and MEG's board of directors has declared our next quarterly dividend of 10 cents per share for payment on April 15th, 2025. With that, I'm going to turn the call back to Darlene for closing comments.
Thanks, Ryan. Before I close my remarks, I want to provide perspective on our positioning amid the current market dynamics. We continue to work collaboratively with industry and government to emphasize the importance of integrated North American energy markets and growing Canada's access to global markets. Looking ahead, our value proposition remains compelling and differentiated for MEG. In 2025, at a US $70 WTI, we estimate generating $1.25 billion in adjusted funds flow, with $615 million available for shareholder returns. That's enough to repurchase approximately 7% of our outstanding shares. We have positioned MEG to thrive through various market cycles with our high-quality resource base, operational excellence, low break-even, and strong balance sheet. This foundation supports our commitment to long-term shareholder returns while providing the resilience to navigate changing market conditions. We remain confident in our strategic direction and are excited about MEG's future. In closing, I want to recognize everyone on the MEG team for their hard work in delivering on our commitments in 2024. On behalf of MEG's board of directors and our management team, I want to thank our shareholders for your continued support. With that, I'll turn the call back over to Ludi and we can begin the Q&A.
Thank you. We will now begin the question and answer session. To ask a question, you may press a star followed by the number 1 on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, please press a star followed by the number 2. And with that, our first question comes from the line of Greg Purdy with RBC Capital Markets. Please go ahead.
Yeah, thanks. Good morning. Thanks for the rundown, Darlene and Ryan. A couple of quick ones for me. There's just on the facility expansion, we're seeing, $470 million, so up, 30. Is that FX or feed or what have you that's getting lumped in there to adjust that? And then can you just really remind us of timelines for the expansion, please?
Sure, Greg, I'll jump in there. The total cost of the project is $470 million. What you're probably recognizing is the number in the business update that we provided at year end was a go-forward number of $440 million. So when you combine that with the $30 million we spent in 2024, that makes the $470. So just simple math there.
Okay.
And
okay.
So does that help? Okay. And then, timelines for the project. Probably what we've got listed out, steam boiler foundation begins and long lead purchases in the first quarter of 2025. In the second quarter, we're looking at advanced engineering model reviews, right? So that's taking you from the 60 to 90% model reviews and major facility tie-ins during the second quarter turnaround. And as you look ahead in the first half of 26, you'll start getting the steam modules arriving in assembly. and steam in service by year-end 26. As you move into 2027, that's when the expansion part of the project, the processing part, comes into the facility expansion.
Okay, that's great. No, thanks for that. And then maybe just to pivot, you know, you referenced just diversification and where the barrels are going. I'm really curious as to what you're seeing on the dock with TMX in terms of appetite for AWS. And then also just curious whether the pricing conditions you're seeing globally right now would actually justify taking on some spot capacity, whether that would be you or somebody else. And just curious whether the math would work at this point.
Thanks for that, Greg. It's Eric. As we look at operations on TMX, we're pleased with how that's been operating. We continue to see smooth operations with kind of no issues during the winter, which has been a positive. In terms of the demand for AWB, we continue to see strong global demand for heavy crude. With TMX, we've had the opportunity to get AWB into more international customers, and their early processing experience with our crude has been great. So we continue to see that strong demand. In terms of the economics around the barrels moving off of TMX, it does change monthly depending on the local demand issues in Asia, what's happening with margins, turnaround conditions, etc. I think where you're likely to see spot shipments moving would be more around the time when, if tariffs come into effect, that's when you'd see the extra incentive to move a significant amount of spot capacity. For now, it's largely the contracted volumes that are moving.
Perfect. Thanks, Eric. Thanks.
You're welcome.
And your next question comes from the line of John Royal with JP Morgan. Please go ahead.
Hi, good morning. Thanks for taking my question. So my first question is on SOR. I know you've talked about the SOR for your new well pads coming in quite low, but just looking at the overall, it ticked up a bit in 24 relative to 23. Can you talk about the drivers there and any puts and takes we should think about for 2025 on SOR?
Yeah, I'll jump in. Thanks, John. Steam to oil ratio for 2024, very consistent with what we've been sharing, more about the timing, steaming the new pads, and you don't get the production back right away. So that drives your steam to oil ratio. As you move into 2025, you'll see that starting to come down. And part of what the better resource that we've been talking about in the business update as we look to the southeast and to the northwest, that better resource, higher oil saturation will start to drive the steam to oil ratio in a downward trend as well. So again, it's really resource driven. That strong resource asset that we have will drive the improvements in the steam to oil ratio as we look ahead.
Okay, that's helpful. Thank you. And then my follow-up is on pathways. Can you just give us the latest on where the industry is in terms of working with the government to find a framework that works for everybody? And how far do you think we are off from that kind of framework at this point?
I'll jump in again on this one. Pathways, I always bring everybody back. Pathways is about driving cost and carbon competitiveness. That's really where the conversations are focused on. The Alliance continues to advance the foundational carbon capture and storage project. So we're looking to transport CO2 on the pipeline through multiple oil sands facilities from sequestration, and then we inject it into the Cold Lake region. Those conversations continue with both federal and provincial, and those dialogues continue. It really comes down to the progress of that is around driving that cost competitiveness. It's getting that to the next steps. And so that's where the conversations and the focus continues. There's meetings happening as we speak right now. That is the focus of the team, and we're still pushing quite hard, to be honest. And again, it comes back to making the oil sands cost and carbon competitive. The fundamentals don't change, and politics don't change. It's really what is happening. We're just needing to drive those two components in order to progress this. So that's really where we're still focused.
Thank you.
And your next question comes from the line of Menno Hulshof with TD Securities. Please go ahead.
Good morning, everyone, and thanks for taking my question. My first one is a follow-up to Greg's on, and I'm just going to drill down a little bit here, just on U.S. Gulf Coast access and more specifically your export capability. How much was exported off the Gulf Coast in the quarter? And if tariffs were to take effect on Tuesday, is there a scenario where the exports, your Gulf Coast exports would be exempt? Thank you.
Thanks, Menno. This is Eric. Appreciate the question. Looking back at the quarter, our exports from the Gulf Coast were in the 10 to 20% range. As we look ahead to the potential possibility for tariffs, certainly our diverse market access strategy, the assets that we have in the Gulf Coast position us well to be able to ramp up those exports very quickly. So with the tankage and the dock space we definitely have the ability to move more barrels. And so depending on the details behind the executive order, based on what we've seen today, we believe that more than half of our sales could be non-tariffed.
Terrific. Thanks, Eric. Appreciate that. And then the second question is on hedging. So the heavy differential, it's tighter than a lot of people were expecting in that $13 range last I checked. Are you seeing any opportunities to hedge that out? And I understand the balance sheet doesn't need it and that your growth is comfortably funded through free cash, but is there any temptation given the tariffs overhang?
Hey, Menno, it's Ryan. I'll take that one. You know, you hit on it. We control risk today with our strong balance sheet, and we have the capability to kind of weather that volatility. When you think about hedging tariffs, you hit it. We would look at hedging the WCS differential. That market is very illiquid, and you're limited in what you can actually put in place and how long the duration of those hedges. And it kind of limits what you can actually hedge. So there's not a lot of appetite to get out there and put a position on because it's just not that meaningful. And when you consider the impact of tariffs, we actually think it may be relatively muted. We do expect that you would see a widening in the differential at a 10% tariff. You might see a $2 to $4 per barrel widening in the WCS diff, but we're also seeing a weakening in the Canadian dollar at the same time that's going to offset that. So from a high-level perspective, it does reduce the free cash flow, but the impacts are relatively low, and you're unlikely to see us get out there and hedge the WCS diff.
Okay. Thanks, Ryan. I'll turn it back.
Thank you. And your next question comes from the line of Neil Mehta with Goldman Sachs. Please go ahead.
Yeah, thank you. One micro, one macro. The micro is we're going into a turnaround, I believe, in the second quarter, Darlene, and just curious on what you want to accomplish during that maintenance and how do you ensure that you get through that as effectively as possible?
Yeah, good morning. The turnaround, I'll start big picture. Team is all over this, highly organized, energized for this turnaround. They're in the final preparation phase, right? So the scope is fully defined and integrated, enabling that detailed scheduling and resource. The planning remains in line with the budget, so no concerns there. And it really comes back to the team is doing, the general maintenance for turnaround. And it's primarily focused on, the 10-year frequencies, regulatory frequencies, and the tie-ins for the project, right? Those will be the kind of major turnaround components. Other than that, it's just your normal turnaround activity that you have at this time of year.
All right, thank you. And the macro, just the follow-up is, you guys said that about half of your barrels could probably be exempt from the impact of tariffs, in part because of the way you market through the Gulf Coast. Can you just unpack that a little bit and help us understand all the ways that you can work around some of these impacts to the extent they go into effect next Tuesday?
Thanks, Neil. It's Eric. Thinking about that 50%, the drivers behind that are, again, the diverse market access that we have. So the ability to move barrels through TMX, through the Gulf Coast, very significant volumes potentially through the Gulf Coast, and a component around the potential treatment of how our imported U.S. sourced condensate is handled from a tariff perspective.
All right. Thanks, Eric.
You're welcome.
And once again, if you would like to ask a question, simply press star followed by the number 1 on your telephone keypad. Your next question comes from the line of Dennis Fong with CIBC. Please go ahead.
Hi, good morning, and thanks for taking my questions. The first one is just around the US $600 million net debt floor. Obviously, we've seen a lot of volatility, and you've even discussed a little bit of the potential impacts of tariffs in a potential weakening Canadian dollar. Can you just remind us as to, obviously, the guardrails, the methodology behind the US $600 million net debt floor, and if that maybe gets adjusted if FX materially or CAD materially weakens in the near term?
Thanks, Dennis. The net debt floor, the strategy, net debt will move up and down just depending on our cash requirements and working capital. You can think of us maintaining US $600 million of total debt. That's our only bond outstanding at this point in time. And we're not necessarily managing at this point in time to US $600 million net debt. So we did have a little bit of cash sitting in the bank at the end of the year. That was working capital requirements. We had to pay our $27 million dividend right at the end of the year. We had a debt payment that was due early in the year. We had share buyback tax that was due early in the year. So we probably held back a little bit more cash than we typically would do in order to pay those bills. So when you think about net debt, it's just going to rise and fall as our cash rises and falls. And the strategy is still the same. When we think about share buybacks, we will look at what cash is in the bank at the end of the period, hold back what we need to make payments and run the business, and then use the rest to buy back shares. So net debt will just fluctuate naturally over time.
Great. Appreciate that context. Secondarily, can you talk towards a little bit around either procurement, supply chain management, and kind of procedures or bits of execution that you've put into place that help you really drive or provide confidence around the execution of the facility expansion project and the actual development of it? Obviously, understanding that you do have several pieces of equipment already on site.
Thanks, Dennis. Good morning. The project itself, I know there's a lot of conversations around project execution with everything going around in the macro. We see low project cost and execution risk right now with the tariff, right? The U.S. tariff. We have minimal exposure to the U.S. in the procurement in this project. A large portion of the fabrication is completed in Canada, here locally in Alberta, and we're using existing working with a number of Canadian suppliers, right? So that it helps us communicate why the risk is lower for us. The project, the complexity of the project is also very integrated into our existing Christina Lake facility. And what that means is it's utilizing similar equipment and processes and capabilities that we've already got. We mentioned we've been spending 25 years running this facility. Our team's got a lot of expertise and experience. The front-end engineering design phase has been complete, right? And so you understand your scope and your parameters, and you're really just moving into that detailed engineering, and that's progressing very well. The project, with its lower complexity, and helps us bring that expertise together, and the fact that we own many of our major vessels and once through steam generator, when you put that all together, we're on track to order, any of the remaining equipment in the first half of this year. So teams really bringing in the engineering, the design, the execution components. A lot of it's done local. A lot of it, any of the long leads that are left are really the team's got line of sight to that. They've got the contracts in place, and really now it's just the execution of that over the next 6 months to 12 months.
Great. Really appreciate those incremental details there, Darlene. I'll turn it back.
Thank you. And I'm showing no further questions at this time. I would like to turn it back to Mrs. Darlene Gates for closing remarks.
I'm gonna share some thoughts about what I've heard so far, and maybe share another the balance sheet. Kind of go from there. That's the MMA. Okay. Okay, so sharing here the balance sheet. I'm gonna minimize myself and make it a little bit bigger here. And then I'm gonna go over the numbers and kind of speak to what Darlene and the team talked about. So as you can see here in yesterday, they just reported this quarter. It's so 100,139 barrels a day production. And one of the questions was associated with their SOR, so steam to oil ratio. And what we see here right now, so what we see here is the SOR that one of the investment guys was talking about, which is 2.4. And the question was, well, before it was 2.28 and 2.39 and 2.27. How come it's higher now? So, and SOR, so steam to oil ratio. So how come it's higher now? And what they said basically is that they're currently at the circulation stage. So they're circulating new pads. I don't think they use the same wording. I don't think they said circulation, but they said, hey, we allocate the steam to new wells, and then the oil is going to be coming later. And what essentially this means is that when you have injector and producer, so they do SAGD, and the way you drain the oil, you develop a steam chamber. So you develop a chamber, and then the oil drains downward by gravity, and you inject steam from here and produce oil from here. But then the oil is really hard, like a hockey puck, right? So if I was to draw here, this region right there, it's very hard, like a hockey puck, and you need to establish communication between them. And so initially what these companies do, they circulate the injector and the producer by injecting steam or hot water continuously and increasing the temperature in that region right here. And that's why the new pads that are coming online, they're being circulated right now. So they're basically creating that communication between injector and producer, so they're able to basically develop those chambers. And that's why the energy intensity initially, that injection to create that communication, is yielding higher steam to oil ratio, because by definition you inject more steam but you produce less oil. Where now that when you bring the wells online, when you stop the circulation and you convert the production well back to being a producer, and steam to being a steam injector being an injector instead of circulating, now you're able to basically do SAGD, steam assisted gravity drainage. So that's why they say, look, this is temporary right now. It's because of the phase where we're at in the project and just circulating those wells. And soon it's going to be get closer to 2.28. And SOR matrix is really important from a perspective of economics, but also environmental performance. So I think that's why they asked that question. Okay, so, and there was another question before on Twitter, is like, why production was 109 before and now it's 100 and then 102. So my understanding, production right now is about 103. And the brownfield expansion project they talked about is taking them to closer to 130,000 barrels a day. And this number 109 in that specific quarter is really a function of that flush production that's what taking place the previous year, because maybe there was like underproduction, and around the standard deviation you get basically a little bit less from average and a little bit higher than average. So 109 was kind of like that. So basically, I guess what I'm trying to say here is that their normal production oil rate is about 102, 103 right now, maybe closer to 104. And this number came from production of 104 in, I think it was in December, it was about 94 in October or November, and the other number was like 102 or something. So as you can see, there's a standard deviation to those production rates. And then when they take the monthly productions and divide, let's say, by like a 90-day or over 90 days, they have like the aggregate production, but divide by 3 or something, they will get like an average of 100,139. So that's kind of my understanding how it works. There was a really interesting question associated with their exposure to tariffs. And what was really intriguing to me is that 50% of the production may not even be impacted. So that's pretty cool. And one of the questions was, I think the bankers were a little bit caught by surprise based on that answer. I don't think people knew that maybe they're not as exposed to the tariffs as originally thought. I think one of the explanation was that they have access to TMX and also Gulf Coast, but the way the diluent, so the condensate is basically imported back from US, makes it kind of neutral on the the penalty. So that's really interesting to know. Wasn't really obvious to me. And then the related question about this was, well, this is 1256, right? WTI WCS differential was $12.56, which historically is amazing. And you can see in Q4 2023, this number was closer to $22. And the bankers very quickly realized, hey, why don't you hedge that? And the answer was that we can't really hedge that, or we're not going to, or think about this, I guess, but still not do that. And the explanation to that, in my understanding, was that the market is fairly illiquid for that hedging strategy, I guess. But also they said something I've been saying for some time now and was thinking about that for a long time, is that if the tariffs are being invoked, and it seems like they're going to be invoked on only 50% of their production, the other part is going to kind of neutralize itself by FX, so by weaker Canadian dollar relatively to US. So they're basically saying, look, we have a strong balance sheet. We don't really need to hedge that. Even if we wanted to hedge that, the market is illiquid, so it's very hard to get in and get out. And thirdly, then the Canadian dollar will suffer probably because of the tariffs, and therefore, because we spend money in Canadian dollars, we also get paid in American dollars, so we kind of get that incremental benefit. And the other comment that was really interesting for me was associated with the procurement for their brownfield expansion project, which Darlene mentioned that they're basically relying on Canadian suppliers. So that cost is not going higher for them, essentially, for the brownfield expansion and their growth plans. So that was pretty good. So that differential is very low. Now, a couple of things I wanted to talk about as we kind of continue addressing some of the comments. For me personally, this number was a very important one. Cash operating netback. This is, and I shared this in one of the tweets. This is world-class number, $41 per barrel in netbacks. This was really, really good. And you can see historically, relatively to Q4 last year, it was good. And also kind of being a weaker quarter in Q4 in 2024. And then you're looking at basically the 2024 timeframe where the prices were a little bit higher. This is only $1 below the, which is amazing, I think, all things considered. Obviously, there is an impact from royalties here. And in their update, they mentioned that the funds flow from operations were about 340 million, and free cash flow was 168. But they mostly talked about kind of the adjusted funds flow element, which I think from funds flow operation, they mentioned 358, and then it was I'm getting all confused here between the different time frames. Let's start again. So what they mentioned is the 2024 annual funds flow, which was 1.38 billion, and then they said, well, free cash flow was 837 million. And if you do like a quick free cash flow yield analysis on that, you get between 11 to 12%, which is fairly healthy. So I just took this number and divided by current enterprise value that clearly fluctuates. And the free cash flow this quarter was a little bit less than a typical quarter. I think it's just over 200 million. And they share that it was mainly because of the kind of turnaround spend, but or some kind of maintenance activity they had, but also because of the brownfield expansion and the procurement associated with that. And then they basically really committed to kind of staying at this level, debt repayment, which you see basically didn't happen. And they were focused on share repurchases, which they did. So in Canadian dollar, they spent 151 million, right? So this is in millions here. So they spent 151 million on share repurchases in the quarter, and they paid a dividend of 27 million for that quarter. And revenues, so 1.1 bill revenues. Net earnings diluted per share diluted is 40 cents here. So in overall, it was a good quarter. Let's address a couple of more questions that they talked about. So we addressed the SOR question. We addressed the tariff question, which was a really good one. And I think they did a good job providing update on that 50% is not exposed. So that was really good to know through their marketing capabilities. The other thing that was there was discussion about, maybe I'll clarify the question. Darlene mentioned OTSG. So OTSG stands for one through steam generation, and basically this is the ability of generating the steam. So the limited bottleneck right now in the brownfield expansion is their ability to generate steam. And the reason why they need to generate steam is that the recovery scheme that's called SECD, they have to have a steam capability to inject the steam to reduce the viscosity of oil to be drained by gravity, so you can drain downwards. And so what she said, that OTSG is basically equipment, surface equipment that generates the steam. So it has like a water injection component to it. You burn natural gas and you create that steam, and that steam is being injected. And so that's what they're expanding. And at the back end on the treating facilities, they're going to be having some equipment that treats the additional emulsion that comes back. So there's kind of a front end and back end. And I think the discussion there that this will be just under 500 million, the entire project. So I think it was like 470. And they provided some schedules associated with that spend, which is great. Yeah, so we covered the WCS diff, we covered the tariff situation, we covered the SOR question, we looked at the balance sheet and their current yield, which was 11 to 12%. And they really refocused this quarter on buybacks and paying the dividend that they committed to. And in overall, I think the balance sheet looks in good shape. For people that always wonder about the production oil rates, this is really important to be mindful of, is that it's going to fluctuate a little bit, especially through turnarounds. And the way it looks on the reservoir level is that when they slow down, let's say production, so here you will have a liquid level on top of the producer, and then they basically will drain that liquid level when they bring the pumps online. It depends on how they operate the strategy. And so usually the oil is not lost, it's just kind of being delayed by a month. But just like you've seen on quarterly production, that 100,000 barrels a day average oil production for Q4 was really through a lot of standard deviation fluctuation between 102, 104,000 barrels a day and 94. So this is something really important to be mindful of. Okay, well, this wasn't just like a quick disclosure. I didn't think I shared this initially. This was like mostly a study for their Q4, MEG Energy Q4 earnings, to better understand what they're reporting. We've heard some questions from investment bankers that they're interested in. I think we learned a lot. Hopefully what I shared here is useful. A couple of quick thoughts that I shared on Twitter, just kind of to quickly cover, is that a couple of months ago I made this post that many people asking what's wrong with this company. I don't think anything, to be honest, wrong with the company, but from there are several perspectives. So you've heard the CEO lady talking. She's a really nice lady. Actually, I met her. Very, very professional, very pleasant person to talk to. and I think she's very competent, so she knows what's going on. And so there's lots of speculation, maybe because she is new, maybe there's something wrong with the stock. Well, it's not my understanding. I don't think so. They started paying dividend. I actually don't think it was a good idea, but they can afford to do that, so why not? I actually think they're doing, because they're low cost of supply, they're better off allocating money towards their business or maybe buying back shares because they trade fairly cheaply. So that's just another thought I have. So the dividend wasn't really required in this case, but it's okay if they do. And they obviously launched this growth campaign to achieve, they said 130,000 barrels a day, so 125,000 to 130, I would say. And I don't think it's a mistake. I think because they're low cost of supply, they're able, to do this. And but many traders, investors, they're very frustrated by stock performance, and so they're very little patience. And so I think the main reason for underperforming is this whole political uncertainty, the tariff risks, right? WCS volatility, even though current price is really good. And, I call it shake and bake, but it's part of like typical volatility in the market. So just kind of some thoughts, holistic thoughts about that. But, in overall, I think they did a good job. $41 netback in Q4 is world-class performance. As mentioned, low cost of supply, and they should be investing brownfield opportunities. For example, if your asset value is, let's say, 80,000 per flowing, 80,000 per barrels, and you can develop an asset for less than 25,000, well, it's kind of like, think about this, like if you were to invest $25,000 into something, and then after 4 or 5 years you realize value of 70 to $80,000 for that thing, would you do it? And so for me, it's kind of a very rational move on their behalf, even though many people could disagree with that. So hopefully it was of value. Again, this is more of an overview study. I'm not a financial advisor. This is information and entertainment purposes only. My main activity is being like a technical guy. But yeah, hopefully you learned a little bit about MEG and their plans in 2025. Thank you so much.